right, good afternoon, everybody. I'm not sure what was going on there with this feed. It told me I had to do some kind of confirmation and verify I am who I am. I am who I am, said Popeye. Anyway, hope you're all having a fantastic trading day out there. It's been one that I got to watch from the sidelines, but excited to see some of these moves as they unfolded today on the heels of yesterday's FOMC meeting. So apologize for missing yesterday's show, but it was a good day. I did make some trades yesterday, which I'll talk to you guys about, but I don't want to waste any more time. I want to get right into it with our guest today. Obviously, with the FOMC meeting and Jerome Powell and interest rates taking the hot seat, probably the most important topic right now, it is a good time to break down what Jerome Powell said, what the markets are anticipating, and some of the behind the scenes, behind the curtain things going on with the bond market. We're going to talk bond markets and interest rates with my good friend, the bond king, Mr. Bill Addiss, joining us today from the East Coast, I'm presuming. How are you doing today, Bill?
Very good. Yes, outside Washington, D.C., the swamp, as usual. So good to be with you and your audience. Thank you, Merlin. How you be?
Good. Always a pleasure having you on. I apologize because normally as I mentioned before the show, I love watching the press conference. Of course, we all know what happened. No rate change. That was pretty predictable. But I like to see what clues and changes have been made, and is the sentiment more dovish or hawkish, and what questions the reporters are grilling him on. I love that. Maybe you got to watch some of it and know some of the highlights. I guess we'll start with, what are your takeaways from the FOMC statement yesterday, and what does it mean to you?
No, great question. First of all, great to be with you. But I have to say, while you were just saying that, I am smirking here because when you and I first met and we were doing this type of thing, I remember specifically you saying, you bond people, you're always microanalyzing every adjective, every adverb. Did he wink or smile? And, here we are years later and you're one of us. You're drinking from the Kool-Aid. So I've heard you compare literally the one statement versus the next statement and see what's highlighted as the changes.
They need to have a Betty Ford, like a Fedaholic meetup. I'm part of the Fedaholic group. Thanks a lot for feeding my addiction, Bill. Damn you.
You've drunk from the Kool-Aid, and I feel somewhat accountable or partially. So I'm glad to have you on board. The meeting was a snore. There was not, in terms of Fed policy, in terms of interest rates, there was no surprise whatsoever. Even in terms of the terminology, the markets, as you see, and we had that one whipsaw where I was paying attention to that silly equity market, but I know at one point equities were up 1% just to give it up just as quickly. But the net result is we got out of the meeting what we expected to. There's no change in Fed funds. There's no change in discount rate, the repo rate that the Fed is doing with the banks to suck out liquidity, the interest on reserve balances, all of that remains unchanged. And the real question the market wants an answer to, and he's not able to give one, is, well, when are you going to start cutting?
Right.
If you're not doing it now, when is the cut? And the marketplace at this point, remember at the beginning of the year, they were talking about 8 cuts this year. Yep. Now we're going to be lucky if we get 1.
Right. Here we go. This is it. So Bill already owes me 3 beers. How many rate cuts do you think we'll have by the end of the year? I got a number.
I'll bet you double or nothing. Here we go. This could be a weekend.
Wait, double or nothing?
Bet you double
might have to get a hotel room.
I know, this could be a long weekend. I'll bet you double or nothing that we could have a hike before we get a cut. But I want odds.
Wow, to double or nothing, man. It's tough because I think you and I have the similar mindset. I was going to say 1 rate cut this year simply because it's an election year. They can't let it go up. You gotta, there's no pressure from our government on the Fed. Oh, bullpucky. There certainly is. Double or nothing that we get a rate hike this year. I mean, you're talking a 6-pack now. Can you afford that? Can you afford it?
I'm talking a weekend. This is turning into a weekend.
Wow.
My point is, go ahead, please.
I'll take that bet. All
right, we're on, and we have witnesses. No, my point is, you put my feet to the fire. I continue to say every time you and I are together, we never hit the 2% inflation target. We came close. We did a great job. Never hit it. And now rates look like they're, getting some pressure the other way. From a purely logical, objective point of view, I don't know why cuts are in the market.
So,
and I think deflation is going to be a problem.
Well, it's very interesting for those that are regulars in this program. You know this, but I've got the CME Group's FOMC Fed Watch tool, which is basically the Fed Funds futures traders kind of anticipating where price is going to be. If we go back just 1 month ago, there was the expectation that we were going to be getting 3 rate cuts. Right now, the odds-on favorite right now, as of today, not updated for today, but just as of last night, is a 35% chance of one rate cut. I mean, that's a pretty big shift, especially when you look at what happened, as you mentioned, in December and January. It was 8 cuts this year, then 3, now 1. So, the trend is your friend, Bill, if you're going for a rate increase.
And I'm going to continue to show that I earn these gray hairs and receding hairline. I remember what inflation can be when coupled with the stagnant economy. And, people are hesitant to even whisper the word stagflation. But, that was the fear we had coming out of the pandemic. And people are starting to mutter that word again. It's scary. I mean, our Fed did more quantitative easing in the pandemic than they did during the entire 5-year recession.
Right.
There's ramifications to this.
Okay. And this has been an interesting discussion because I agree with you that it's off the charts insane how much money was pumped into the economy. And of course, a traditional finance degree, which I do have, tells you put more money into the economy or more money into circulation, that leads to more money chasing the same amount of goods and services. Therefore, you get inflation. Okay, that's like Econ 101.
Right, exactly.
And we did get it, right? Of course, everyone says, oh, it was Biden did it. Oh, it was Biden. Well, look, you could blame Trump. You could blame whoever you want. It's not the president directly's fault. It's the central bank, in my opinion, that's the big culprit here. So
the president doesn't control the economy. The president has nothing to do with the economy.
Exactly. So when you mention stagflation, the general definition is 3 main variables. You have decreasing GDP, so declining GDP. Doesn't be negative, but just slowing GDP growth. You have surging unemployment, right? You have to have jobs just disappearing and people like lining up for the soup kitchens. And you have to have inflation higher than normal. Now, inflation has started to tick back up. Granted, I don't think it's astronomically high.
Right. Exactly.
But it's starting to trend up. You have GDP has been contracting the previous 2 quarters, so check. And you have unemployment has ticked up from like 3.8 to 3.9 to 4. I wouldn't call that definitively stagflation, but it's also the beginning of potential trends. So,
agreed.
Do you see it coming?
That's why I used the word. They were starting to whisper that word, stagflation. And I would point out, so many people like myself like to go back to 1979. When we were talking inflation as a problem in 1979, it started at 6% and ultimately went up to 20%. We're talking about inflation now, but let's admit we're starting at 3. We're not starting with the huge inflationary pressures we had of 1979, nor do I think is anybody expecting that. So, no, the word whisper, I think, is the way to approach the whole stagflation. And maybe it's, call it a soft landing that's not so soft. How's that?
I'm tired of the word soft landing, honestly. It's just so annoying to me. It's soft landing.
You and me both. Agreed.
So I was trying to bring up a chart of the historical inflation rates here in the U.S., just so we can kind of see what that might look like. But I'm struggling to find the right chart that goes all the way back into the 70s. You said I like to go back into the 70s. I would, too. I think in 1979... Robin Williams was my babysitter. So I'd love to go back to 1979, knowing what I know now. Here we go.
If it helps you, it's a correlating chart. I sent you the Fed funds chart in my deck, and that'll kind of show you the same thing going back to the 1970s.
Yeah, I brought up one here of inflation. You guys can see that big surge in the 70s.
Okay, go
but I do like your chart better, so let me bring that one up here real quick. Yours was actually much better. There we go. Here you guys go. This is straight from the Fed, so why not?
This is from the Fed themselves, exactly. And the reason I wanted to include this chart is it kind of drives me crazy. I'm hearing a lot of talking heads on TV this week talking about, the Fed funds rate is at the highest rate in 23 years.
Yep.
And, that is, yes, correct.
It's true.
But I would point out the last 20 years included a 5-year recession and a pandemic, both of which were year-long events that forced the Fed to keep rates low.
Right.
So if anybody doesn't have gray hair, a 5.25% Fed funds rate might indeed seem high relative to the last 20 years. What I was trying to show with this chart is anybody with a longer focus, look at that Fed funds rate up close to 20% in 1981.
Yeah. I mean, heaven forbid we should get up to those levels, but...
No, nor am I pro. Yeah, I really am trying to say we are not in a 1979 scenario. I'm not trying to present that argument at all.
Yeah,
but
I knew that.
Yeah.
you were talking about, so let's break down these elements one by one. I mean, I know it's kind of deviating from the normal talk track, and we'll talk about Fed funds, but
Cool.
we have GDP contracting, and do you have a take on that, on what you see going on with GDP, or the continual kind of slowdown with GDP? Because we'll break down those three factors that we talked about and see if stagflation is in fact the evil beast we think it is.
Yeah, no, that's a great question. GDP is such a gross measurement and goes through such seasonal adjustments. When we had a GDP positive of 1.2% coming out of the pandemic, a lot of people were making the argument, no, we were actually still in the recession.
Mm-hmm.
So GDP has a lot of variables to it. It is such a broad, I'm going to sneeze, that's why I keep doing this. Such a broad gross measurement. The only thing that is good about GDP is every country basically reports it the same way.
Yeah.
So as a comparative measure, that's what I like about GDP. If you want an apples to apples comparison, comparing the US with India, with the UK, three very different economies, we all compute GDP the same way. There's a synergy, there's a consistency there that's nice.
Yeah.
Is it accurate? Absolutely not.
Yeah. Well, it's just such a measurement that they use, and I brought it up here so people can see. This is the advanced GDP, which came out last Thursday on the 25th of April. It shows us at 4.9%, and that's an annualized rate. So we went from 4.9 in October of 2023, then we went to January of this year, we dropped to 3.4, and now we're dropping to 1.6. And I mean, that is a clear 3-bar trend, but it doesn't mean that it's going to, the next one's going to be negative, but it does show that things are certainly slowing down. So that does check a box for the stagflation, right? And
yeah, absolutely.
And you will see, I did see a comment come in earlier from, was it Margaret that said it? One sec, where is it at? I think you said in there, Margaret. Someone said, what about a recession? Or what are the odds of a recession coming? Well, that'll kind of dovetail off this discussion, Margaret, which is, one of the metrics for a recession is 2 consecutive quarters of negative GDP. Well, we had that back in April and July of 2020. And of course, that was COVID related. And we also had that back in April and July of 2022. Well, here we are going into
that didn't happen.
Yeah, and who knows? We might get that negative tip here in our next couple of quarter readings. But that's the first piece, which is GDP declining. Right. The trend looks down. Let's go to the jobs data, right? Unemployment numbers.
This is my favorite.
Oh, is it? Okay, I love it. What's your take?
Well, again, because I apologize. Many of your people and you have heard this all too often from me. But, the way we quote that unemployment rate of the U3 number, and, talk about a 3.8% unemployment rate. That's just misleading. I still bang the drum strongly of the participation rate being a much more important metrics. And it does not show the strong market of economy in terms of jobs that the unemployment rate does. I mean, we literally just last month crossed the halfway mark that half the people that lost their jobs during the pandemic are back in the workplace.
Okay.
We went from, I'm going to do these numbers off the top of my head, so they might not be exact, but we went from about a 63% participation rate before the pandemic. 63% of the working population was employed, 18 to 65. That plummeted to 60% during the pandemic. Biggest drop we ever saw. Now, again, we all know anecdotally, a lot of reasons, right? People left the workplace during the pandemic, reevaluating lives. There was some demographic shifts, but we saw the biggest drop in participation we'd ever seen in that period of time. We have only made it back half those jobs. We just crossed about 62%. So everybody who left the workplace, in terms of just demographically speaking, has not returned.
Yeah, we're not back up to where we were. So I have the chart up here. This is from the Fed as well, labor force participation rate. And you're right. I mean, this drop is pretty substantial. Of course, we know that was going to happen from February of 2020 to April. I mean, we went from 62.6 to 61. So a significant, to 60. Significant drop. And here we are now at 62.8. So we're not quite back up to that 33.3 we were before. But it has been growing. It has been looking good. And, the unemployment rate that you talk about, which I don't believe either, but I have to because it's what's being told to me.
Exactly, right.
That's this U3 rate that you guys see right here. It says 3.8. That's the current number. And we get a reading of this on Friday, which may further add some fuel to this fire of stagflation debate. Most people would agree it's the U6 rate is the more accurate reading of unemployment in the United States. And that's 7.3%. So I just had to throw those two out there because if we're going at
it's So I just don't think the U3, and there's ramifications for this politically and so on. The U3 number is always going to look better because your audience is so much smaller. So the press, the politicians, they love the U3 rate. It's always going to show better than normally will show better than the participation of the U6. Absolutely.
And then the last part, inflation. Clearly,
Yeah.
inflation is dropping significantly because my I bonds just got dropped to 4+%. So clearly, there's something amiss here with regards to that. Let's start with the I bonds and then work our way back into the inflation. I bonds got dropped. I saw you had an article or posted an article on that one. Give us an update on I bonds.
Yeah. So May 1st was the reset date. The I-bonds adjust their coupon every 6 months. So it's May 1st and November 1st. And May 1st was the reset. And the new rate is 4.28% for the next 6 months. That's down from 5.26. So we're down almost a full percentage point from the prior month. Janet Yellen, got to thank her because once again, she juiced the yield up. The actual inflation rate should have been 3.96. She added this semi-annual an extra 1.3%, as she did last time, to juice it up to the 4.28 that we're going to get. So, I like Janet because on the one hand, she keeps talking about we're overspending, the deficit's out of control, and then she keeps giving us money that the government doesn't have by way of more interest on our I bonds. So thank you, Janet.
Yeah, I'm very happy with that. Please give me more money. Thank you, ma'am. I have another.
Right.
But
so that'll be the rate for November 1st now.
Okay, and that's good. If we look at the core PCE price index number, so there's a lot of different ways we can look at the inflation numbers, right? CPI, PPI, and core PCE are typically the three that everyone's focusing on. The Fed has made it a point that the core PCE price index is the main one, and here's your chart of that for the viewers at home. I'll show you this chart all the way back into 2005, as far back as I go. And you can see kind of where my cursor is. It looks like the long-term average of the core PCE price index is about 0.2%. Of course, 0.2 times 12 is 2.4%, which is conveniently the Fed's target. Now, we haven't really been below 0.2% all but 3 times in the last 4 years. We are at 0.3 right now. That number came out in line with expectations last Friday. And of course, I think this is the single most important data point for the Fed right now. You mentioned you think inflation is going higher. Why?
Well, again, the Fed likes PCE, and I'm not going to disagree. It is a more dynamic rate. I'm old school. I look at CPI, I look at PPI, and those have shown increases for the last 4 months. Now, again, I'm not going to disagree. PCE, as you said, Powell loves it. The Fed is putting emphasis on that. And I think we've discussed in this program, it is a more dynamic number because it resets every quarter versus the CPI keeps the basket unchanged annually. So there is an integrity to the PCE. I'm not going to deny it. But I also, I feel like when people say, yeah, but don't look at CPI, look at PCE, I feel like those are the same people who said, yeah, but inflation was only transitory. I'm looking at a growing CPI rate.
Yeah.
I also am looking at the fact that even at PCE, we never did affect the Fed's target. We didn't get there. I want to give them great credit. I mean, I love the Fed. I really have to get a life. I'm not sure I love the Fed. I enjoy the organization of the Fed. It makes sense to me. They're a client of mine. I think they can screw up, and they have screwed up at times. But, I do think that the Fed looking at PCE is probably the right thing to do, but it's only one of a number of variables. And I'll give the Fed great credit. Inflation hit almost 10% during the pandemic.
Yep.
I mean, they've done a great job. They brought inflation down from 10 to, let's call it 2 and change, to be generous.
Right.
But unless I missed something, they never hit the goal.
Yeah, and they were trending towards it, right? That was the key. They were kind of, and it felt like everything they had done, which, was unprecedented. And I agree with you. At times, I sound like a Fed basher and I'm abolish the Fed type thing. Look, they have an impossible task. It is impossible because you can only make everybody happy for a very short period of time before one side gets upset, whether they've got too much inflation pressure, you got, the dollar's weakening, and I got whatever the case may be. It's an impossible. You show me one person that everybody looks at and goes, that is an amazing person. No one will agree on one person being perfect. There's always flaws. So I look at what the Fed has done, and while I do blame them for putting us in this situation, I like how they're trying to get us out of the situation. And one thing I tell my viewers is, everybody who bitches about the Fed should kind of step back a little bit and say, they have made me a boatload of paper profits in my 401ks and my IRAs, right? They've juiced these markets.
Look how the U.S. economy bounced back.
Yeah.
Look how quickly we bounced back from the pandemic. We led the world in our bounce back. And that's thanks to the Fed stimulus and the government stimulus. So, yeah, we've got one of the strongest rebounding economies in the world, and we've got the Fed as a major factor of that. I believe that.
And this is why I hate the Fed. You know why I hate the Fed, Bill? I despise the Fed because going back into April and June of 2020, I had 420 puts on the S&P 500. And these SOBs juiced that market straight up. Damn you! Damn you!
They started printing money. Well, yeah, we talk about it. The pandemic was quantitative easing on steroids.
Yeah, it was.
Our Fed went out and just started buying everything. Corporate bonds, muni bonds, private placements, equity, ETFs.
Yeah.
It really was quantitative easing on steroids, and now they got to undo it.
So, you mentioned the stagflation argument, and obviously we need to see inflation continue on up. Do you see it as slowly, like a slow incremental increase? Because we are seeing, I still think that oils and gas is going to be the number one driver of inflation for the next, 6 months or so. But what is it in your mind that's going to cause that inflation to continue to rise up?
I'm really of the argument, and again, I keep coming down to supply and demand, and I hate to oversimplify it so much, but there's just still so much more liquidity in the market than we had. I go back to, like yourself, I'm a traditional Keynesian. We've got all this liquidity still in the market. Now, it's getting better. We can talk about the Fed's balance sheet coming down, M1 coming down, but there's still a huge amount of liquidity in the marketplace. So, I'm really of the camp, just higher for longer. Mm-hmm. I'm not saying the Fed is necessarily going to be raising rates, but I do think we're going to be where what the marketplace likes to call the neutral rate. What exactly is our neutral rate? That interest rate that will keep inflation from being too much of a problem, but let the economy grow. And, it's an academic discussion, but, a 5 to 6% neutral rate kind of makes sense to me with our growing, we are a strong economy. I'm not going to deny that.
Mm-hmm. Another piece of this, so I agree with you. I don't think that inflation is going to have this monstrous surge where it's up to 9% in a few months. I don't think that's going to happen. But I do think that this might be the new normal. Right? Are we looking at a 3% as our normal inflation rate for a while, given the way that things are going? And I think that's probably logical. I do think that the unemployment number is going to creep up. But the thing is, right now unemployment number is 3.8 for the U.S., the U3 rate, and they're expecting it to stay there. I make the argument that at 3.8, they should be having huge celebration parties, because if you look at any historical chart, this is below any historical number. Getting back up to 5.5%. Now we're like, okay, it's getting a little high. But I mean, they've got so much room to wiggle here. I don't think the inflation's or the unemployment side of this is an issue really at all at this point.
I agree with you. It's more the inflation side. Out of the three, the one that is the most volatile potentially and the most difficult to ascertain is the inflation component.
Yeah. Yeah, and I love it. One of the things I've learned the more I do this is there's always something that is the lead talk track, that piece that's in the mouth of every analyst and every trader. And I've been choking on inflation for 2 years now. It's just, can I get something else? I'm tired of inflation.
Yep. I will admit I'm a Bloomberg fanatic, and on the morning they kind of become a joke about it. It's like, okay, what's today's inflation talk? That's all we're going to talk about.
Yeah.
And then, you talk about it being the wind in the sails, but that is the unfortunate reality. It affects so many, the other asset categories. It has become a primary focus.
Absolutely. Let me see. You had some other graphics here I want to make sure I get, since you took the time to prepare some graphics for us. We talked about the respective where we were. That was the interest rate. Oh, so you got year ago interest rates. I'll start with that one.
I was just trying to compare. Actually, it wasn't a year ago. It was last meeting. So I was comparing the last FOMC meeting to this one. So in 8 weeks, and what you can see is that, we have seen a pretty good upward shift in long rates since the last FOMC meeting. The 10-year was at a 435 then, and we're now at a 465. So, we're up 30 basis points on the long end of the market, and the short end is unchanged because the Fed's unchanged.
Well, this looks like a great way to help with the inversion of that yield curve, doesn't it?
It's less inverted, right? We are uninverting.
Yeah,
after 16 months, maybe. I don't think so, but certainly this last 8 weeks, the yield curve is uninverted a bit.
Yeah. It's well, it's tricky when you look at these charts, figure out where things are going to be headed in the future. But all in all, I'm still in the camp of this long end, which has been drifting lower here. I feel like, actually, it's been drifting higher over the past month. I think that this is going to continue. And again, that blue line he mentioned is the most recent reading. The red line is the one from back in March. And you can see that the long end of that yield curve, that 10-year has gone from 4.2 something up to 4.6 something in a 3-month or 8-week window of time. If trends continue, and I'm a huge believer that the trend is your friend until the bend at the end, what we're witnessing now is that short end is stuck, right? It was supposed to be 8 cuts, then 3, maybe 1. Bill said there might even be a raise, and he took a double for nothing bet for 3 beers with me. So I want 1 cut. All I need is 1. No raises this year. I now have incentive to cheer for that one. But if there are no rate cuts on that short end, that long end naturally should slowly start to increase. And one of the driving factors that you've mentioned many times is they're selling more and more bonds, right? They're selling an unbelievable amount of bonds. You mentioned the highest levels you've seen in a long time. You want to elaborate on that?
Good. You remember.
I try to. So how significant or how much more are we seeing on these longer term maturities come to market?
I think that 5% is the next move for the 10-year, because the fact, again, it's a question of predicting the future. I'm going to sound like Powell, data determinant. But we got, as you just said, we have 2 factors that we've been talking about are responsible for this. And hindsight is easy because we have that abundance of supply of long paper that you just made reference of, and we had the prospect of inflation kind of, not going down.
Yeah.
Put those 2 things together, we should expect long-term rates to go higher. Well, government spending isn't any better now this quarter than it was last quarter. We're not going to raise any more money, but last quarter was the most we ever did in history. So we're going to keep at that pace. So we've got an abundance of supply coming into the market again. And as I've said, I'm worried about inflation. So the factors that brought us from a 4.27 to a 4.63, I don't think are abated. I think we're going to continue to see that upward drift.
Yeah. Well, there's the chart of that 10-year. And again, I've been saying how I believe this is going to go higher. I do think you'll see 5% on the docket for this year. Big Eb, who's not here today, he actually bet me will be below 3.99%. He owes me a beer for that one, but he's still got till the end of the year, Bill. My refrigerator or my gullet will be full of beers from Victorious, although I have lost 2 wagers to Mike LaRusso. So unfortunately, I made him a bet that the Niners would win the Super Bowl, which we gave that one away. And the other bet was that Donald Trump's scam stock, DJT, would be below $18 in 30 days, and it didn't get there. We got to 22.
I would have taken that bet too. Yeah, that's a shocker, isn't it? Yeah. That's,
hey, we'll see. I'll tell you what, if he becomes president again, then that platform will probably soar. And I think that maybe that's the futures indicator of the election is what's going on with the DJT.
That'll be a good indicator to watch as we get closer.
Certainly. You talked about government buybacks, right? Which
yeah, well, because that was the announcement. So, if I may, the 2 things that really were interesting in my world from the meeting this week was, number 1 is they are reducing the tapering.
Right.
The tapering is them destroying money. And that is the easiest way to get liquidity out of the market, just literally destroy money. And that's what they've been doing for the last year. They destroyed almost $1 trillion in the last year on a monthly basis, doing about $90 billion to $112 billion a month. Now, and that literally, just goes supply and demand 101. Get money out of the market, destroy it. And that's what tapering is all about. Now, what they announced is they're going to cut that tapering. Now, that makes sense for reasons we'll explain. So now, instead of destroying $60 billion out of their treasury portfolio, because the government has a portfolio of treasuries, and it has another portfolio of mortgages, and they account for them very differently. So on the treasury side, they were destroying $60 billion a month. They're going to drop that down to $25 billion. That's a pretty substantial drop. Yeah. Now, on the mortgage side, they've been destroying $35 billion a month, and they're going to maintain that.
Okay.
So all total, we're going to be $60 billion a month combined between mortgages and treasury.
Versus
the real question I would ask this, I'm sorry?
Versus $95 billion.
versus 95. Exactly. I put a quote in there. Jamie Dimon worried about all of this draining of liquidity. He's worried about a push up to rates to about 8%. But the question I would ask is, and maybe I don't know how far we want to go with this, is I would beg the question, why is the Fed even buying mortgage-backed bonds to begin with? What is the Fed doing, bailing out the mortgage market still?
Yeah, makes no sense
I
to
mean,
me.
I can understand during the financial crisis of 2008, when the Fed started doing QE, they started buying mortgage-backed bonds because that's where all the risk was, right? The mortgage-backed bonds were going into default. So the Fed said, we'll take the risk. Thank you very much. Jump to 2020 or 19, when they started QE on steroids, mortgage market was in great shape, right? Housing market did great during the pandemic. Why has the Fed been out there buying all these mortgage-backed bonds, continuing, and now not even destroying some of that money like they are? Could it be, the cynic might say, because the Fed is owned by the banks and the Fed is treating the banks very nicely here?
Maybe. I'm in that camp.
Yeah. I mean, there's no reason to be bailing out the mortgage market. It's in fine shape.
It's in fine shape. I mean, you could pull up pretty much any metric across the board, and housing has been, and now it's starting to slow down a little bit now. Of course, it had just this monstrous bull rally, so maybe now you start buying mortgage-backed securities.
Right. But why was the Fed in there during the pandemic supporting a market that didn't need supporting?
Right. So Pepe and Jer asked kind of the same thing. Kind of, what do you mean by destroying money? It means they created money out of thin air. Now, they didn't print more money, right? That's a fallacy.
Right.
The printing presses weren't printing more. It's just a digital entry where basically the Fed was out there saying, hey, we need to help our government out here. So what we're going to do is we're going to buy whatever the 10 years they issue, because we don't have any buyers of it. So they say, how much you need? I want to buy $500 billion worth of bonds. I don't have it, but here, I'll just tell you I have it. I put a little ledger over here, a little IOU bucket, and I release that. What I've done now is put $500 billion worth of new money into circulation. That is actually on the books, circulating now. That created the inflationary aspect of our markets. Now, what Bill's talking about is the Fed is unwinding their balance sheet. So they bought all these bonds and financial products like mortgage-backed securities. Now they're selling those off because they're too exposed. They bought too much of this stuff. They have to sell it. When they do that, and let's say he said it was $95 billion a month. That's $35 billion of mortgage-backed securities and $60 billion of treasuries. They'll sell those, take that money, and put it back from where they magically created it from, technically removing money from circulation. That's essentially what that means. Hopefully that cleared up a little bit and made some sense there.
Great clarification. The only thing I would point out, even as a preface to that, is, when I say they create and destroy money, everyone thinks of, piles of bills burning. I just point out to everybody, even now here in the U.S. economy, 96% of our money is virtual.
Right.
Literally only 4% is the bills and coins we walk around with. So with a push of a button, as you said, the Fed can create money into the banks and destroy it. And that's literally what they're doing, is with a push of a button, they're just been destroying $95 billion a month out of the U.S. economy.
Yeah.
From selling those treasuries.
When you say destroying, it does sound like there's this fire sale and they just got a big dumpster and they're just throwing money in it. They're literally just digitally removing it from supply. And one thing I want to make sure you guys all clearly understand here is, if you have a certain amount of money in circulation, that's the money printed or money available, and you're now removing money from that, you guys tell me in the chat, what do you think that's going to do to the value of the U.S. dollar, right? If you've got $1 trillion, I'm just making this up, but if you have $1 trillion and I take away $100 billion of that, I now have $900 billion. What's the value of the dollar going to do when you take money away from circulation? This is important. It's not as simple as, the Fed's unwinding their balance sheet. They're removing money, and that should have a pretty clear impact on our markets going forward. And I think, from my perspective, that's opportunity for you, right? I don't think the average American understands that when you remove this action by the Fed is removing money, therefore price of the dollar goes up. You have the same amount of people chasing fewer dollars.
So, it all comes down to supply and demand, like everything else. It really does.
It's scary, and I'll bring up the dollar chart here for everybody so you can see it. The dollar since December of last year has been in a very nice uptrend. Now, this isn't an uptrend like you'd see in Apple or Intel where it's up 75% in a year. That doesn't happen with currencies unless you're like in Argentina or Bolivia or Ecuador or something. We've moved up 5.84%. Remember, this is the value of our global purchasing power, most powerful currency in the world, in 87 days. Just 87 days has increased 5.8%. Now, if you're Japan right now, you're pooping your pants. I mean, the Japan, look at the US dollar, Japanese yen. We've had a sell-off for the
reasons
past...
that make no sense.
No.
For reasons that are illogical.
Yeah, it is.
It scares me. I mean, when Japan finally stopped easing, at their last central bank meeting, when they finally said, we're giving up negative interest rates, we're giving up easing, the yen should shown huge strength.
Yeah, it has for the past 2 days.
What, 155?
Yeah.
But look over the since the last meeting of a week ago, we're still down to the 155 level.
Yeah, we hit a high.
Is scary.
We hit a high on Monday of 160, and today we're at 160, 153. Really? So I mean, it's a pretty big drop over the past 3 sessions, but still, this is a result of that unwinding in the balance sheet. It's not exclusive, but it is a factor driving this higher. And again, guys, the higher the dollar goes, that the more it costs us for our debt obligations, the more it hinders our economy, the more it makes American goods and services less desirable to somebody else. So for example, if you are trading if you're from Japan, every time now you've been buying goods and services from America since 2023, it's gotten more expensive every time you buy from the United States. And at a certain point, they're going to stop buying, which does hurt the economy in the long run.
Exactly. Perfect recap.
Econ 101. I learned from the professor here. Speaking of which, your fun begins. For those that don't know, Bill not only gets to come on here and educate us for free and join us, which we greatly appreciate, but he gets paid probably decent money to go speak for BlackRock and the Fed and other different financial firms. Your fun's just about to begin, huh?
It is. Literally next week. We start with the virtual sessions. So between BlackRock and Wells Fargo and Bank of America and the Fed, yes, I'm name dropping. The next 2 months are going to be very busy, and it'll be about 3,000 new hires to the financial services industry that I'll have a chance to get in front of. So the industry is very seasonal because Wall Street and the banks hire this army of college and graduates, MBAs and undergrads, and we get to train them for the next couple of months. So it'll be a lot of traveling, and it's going to be a lot of fun.
Shaping the future. I love it.
One mind at a time. Frightening.
I'm going to bring...
But I still have a busy month with you guys, though, too. I've got a nice level of things going on with you guys.
Well, let's bring that up here. Let me just bring it up here. You had a... 1 second as I make this full screen over here. Perfect. Here is the upcoming schedule for those of you who might want to see what Bill is up to. On Friday, is it this Friday? This Friday at 2:30 p.m., he's doing his weekly companion session for his focus class, which is called Canary in the Coal Mine. I love it. Bonds, Canary in the Coal Mine.
You named it.
I assisted the naming. May 29th, he's doing an XLT, Understanding MBS Mortgage-Backed Securities, and it was ABS, is Asset-Backed Securities? Yeah, it says it right on the screen.
Correct.
If I could read, I'd be special. That's on the 28th of May. The 23rd of May, his focus class, which is Bonds, Canary in the Coal Mine. These are all for online trading or Trading Academy, since they dropped the online from it now. I guess I just called it a TA class.
Oh, that's right. Yeah. Sorry.
No, it's okay. I'm getting used to it myself.
All right, good.
And then for everybody who is interested, Bill has a phenomenal 3-book series out there. I saw the plug earlier from one of our viewers, what did he do? I forget the gentleman's name. He was in there.
Veal is the author. Yeah.
No, it was one of my viewers. Old Blocker. Old Blocker was mentioning, he goes, I'm going to gratuitous plug for your book. So anyway, if you go to his website, which you should check out, he's got some videos there. I had it up here. I did have it up. Let me.
Thank you. Yeah. Thank you.
I don't know what.
Yeah, you and I have got some videos up there together, I think, as a matter of fact, from the old days.
Good. Explaining duration and opening. There we go. It just took a while. There we go. So here's the page for it. I will drop the link in the chat for anybody who is interested. It's a fantastic 3-book special. You're not going to find a better deal on 3 books of this kind. You see the 3-book series is $25, or if you want, you can buy each one for $15. But the astute finance advisor would say just buy all 3 for $25.
do it as a bundle. Do a bundle trade.
It's funny. Somebody sent me a picture, Bill, and it was a picture of like a 7-Eleven super, little convenience store, and had a little thing on the counter that said 1 cookie, 99 cents, 3 cookies, $3. I was like, you got this backwards, kid. You need a discount, incentivize me to buy. Can I just buy one at a time and save myself 3 cents? Oh, man.
Don't get me started.
I will try not to. I'll try not to. Anything else on your plate that you want to discuss before we take off?
No, the only thing, and just as a minor footnote, because there was one other thing from the meeting, just to go back, and I know we're kind of wrapped up already, but one of the things the Fed did announce is they're actually going to start buying back treasuries. We've got a lot of small issuances out there. And you remember the repo market we talked about, where we lend these treasuries back and forth? Well, you have a lot of small issuances out there. You got only $1 billion of a bond outstanding. It's hard to find that bond sometimes. So the Fed announced the meeting, they're going to try and clean up the market, and they're going to try and retire smaller issuances that are outstanding in the market. So the way they're going to do that is they're going to do a reverse auction. You dealers can try and sell your treasuries back to the government. Now, this isn't going to increase the deficit in any way because they're going to issue new treasuries to replace the old ones. Does that make sense? Yep. They're just trying to get these smaller, more illiquid issuances out of the market.
Cleaning house.
So there's actually a reverse auction process they do that we did under the Clinton administration. Back in 2000 and 2001, the government had a surplus, if you remember. And what they did with that surplus is they bought back U.S. treasuries. In an auction process. Well, they're going to dust that off and do that again with these smaller issuances.
Interesting.
Yeah.
News.
Unfortunately, for the retail investor, it's hard to take advantage of it. But for the institutional market, there's kind of some interesting kind of arbitrages that exist now then.
Yeah, well, it's interesting just knowing the inner working of what's going on that's not a mainstream media topic, right? Just something that most people don't know.
Exactly. Cool.
Awesome.
Hey, man. That checks my checklist of things from the meeting.
There you go. I hope this year ends very quickly because I'm looking forward to my 6-pack. You're in trouble now,
thirsty.
Man. Pretty soon it's going to be up to a keg, buddy. I hope you don't have like I hope you don't have like a what's a DraftKings account. You're not doing so hot against me.
Don't worry. I look forward to paying off. I'll make it out there to the West Coast eventually.
Looking forward to it. Well, thank you very much for coming on, my friend. We'll
and good luck at the Money Show in San Francisco next week.
Yeah,
congratulations.
Thank you.
I saw that flyer.
Yeah, it should be fun. I don't know why they keep kind of pigeonholing me into crypto stuff, which I'm like, okay, fine, I'll talk crypto. I'd like to talk more topics than just crypto, but it'll be fun. It'll be a good time. So yeah, thank you very much. If you're out there, let me know. Maybe we'll get you on stage at one of these things. You should be.
Love to. The Merlin and Bill Show.
Sounds good. All right, buddy. Take care. Thank you so much.
All right. Thank you. Be well. My best to all.
Guys, that was Bill Addiss giving us some insights into these markets, man. Some good stuff out there. I really love when he comes on the program and shares some insights and just experience. How often do you get someone with 40, I think he said 46 years of experience in the bond market? Pretty good to have him come on, especially when there's no real incentive for him to come on this program other than sharing some knowledge and just being a downright good person. So I gave you his calendar there. He's got a session this Friday for his focus course for Trading Academy. He's also got XLT, Understanding Mortgage-Backed Securities, and then his class starts on May 23rd. So if you would like to learn more, you can sign up for those at tradingacademy.com, or you can also go to his website, which is Amherst Financial Training, AFT Training, aftraining.co, which I had on his name earlier, and there's the page there. He's got all kinds of videos, and he says he's got some media with me. Maybe I'm actually going to be on this page. I don't know if I got my royalties from this one, but probably got. Oh yeah, these are some of the videos I think we did with Trading Academy. Anyway, I'm going to wrap that up and let's get into what's going on with our current markets. I did see from VB Met Apple, which was clearly the most important one of the day, which we'll call the popcorn trade of the day. Apple did beat earnings, looking very good after hours. Here is your chart of old Apple, and you look at it and you go, I don't really feel like anything's happened with Apple. What's going on? Well, there's a dashed red line up near the top, way up here. And that is the current price of Apple. I'll show you the after hours trading here, which we'll do it on a 1 minute time frame. Boom, big pop right as that number came out, rocking to the upside, hit a high price of 180. I'll give you the exact high price here, 186.63. Currently trading at 184.25. I close at 173, so you're up another 6.5% from the closing price for Apple, which of course is having an impact on the NASDAQ futures, which you can see here. Remember, it is the second biggest component of the index of the NASDAQ 100, and that's having a nice pop as well. So continuing today's nice little rally up. And then you have S&P as well, feeling the Apple love on your earnings calendar. So there you go. Other things that were noteworthy today, and I'll just real quickly go through these because I need to get back into studio. Took a little break. Todd is editing some more videos today, so we'll be rocking here soon. We already looked at that dollar index, but here is the daily time frame of that one. Again, nothing spectacular in my opinion going on with the dollar index right now, but long term, we are, or at least intermediate term, for the past year and a half, we've been doing pretty well with that dollar index, and we'll see if we can get above that 106.80 mark, which was my target. I do think we'll end up hitting that here soon. Again, the unwinding the balance sheet causing part of this move up in the dollar. And what's interesting is what Bill was talking about is the Fed is going to go from $95 billion a month of destroying dollars, right? Removing it from supply, dropping from 95 to 60. I mean, that's a 30% decrease in the amount of, actually 30 to 60, 30% decrease plus in the amount of money that they're retiring. So that should slow down this ascent of the US dollar, but still they are continuing to retire dollars, take it out of circulation, and that should drive prices up. So that's an interesting piece. Gold on the day, down 0.06, but nothing really that interesting here other than it's been on a downtrend for the past 2 weeks. You had crude oil was slightly down as well today on the heels of a pretty substantial Wednesday decline. I think if it does drop, you're looking right around that 77.80 mark would be a nice target for that one to have a bounce off of. Number 5 on our list, that's that 10-year, which we looked at as well. One thing I will say about the 10-year, I am obviously bullish on it, but kind of like we did with the NASDAQ, there's kind of a level right around that 4.57 mark that it's bounced off of several times. Bounced off it on today's session, and now we're kind of hovering there. If we get a close down below that, it does feel like there will be some more downside pressure here. So just kind of keep that in mind as that demand zone does become void and broken. We might see more downside here. Now, the big stuff is top 4. S&P was your 4th place finisher, up 0.89% right now. It's, of course, after market close, so impacted by Apple. See, it's a nice little pop there at 50.91. NASDAQ also doing well, and we'll probably have a nice little surge tomorrow because of the Apple earnings, 1.21% right now. Russell was your big leader, up 1.88, although the past couple weeks really feels choppy. A lot of big candles and sideways action, a lot of uncertainty. And your leader today, recouping some of its significant declines over the past couple of weeks. Bitcoin up 4.2% today. I still am in the camp that I don't believe we're totally done yet. We could certainly see some more downside movement, but if you look at the on-chain metrics, there's a lot more buying coming into Bitcoin right now from whales, which is an important driver of Bitcoin price. So there we go. Apple did, but that unemployment number was a big one. If it's above 3.9%, markets will be good tomorrow. We'll see. Market's going to be good either way. Apple will create that excitement for tomorrow's markets, and the question is, how does that unemployment number come in? Let me show you the economic calendar here just so we know kind of everything that's going on for tomorrow. And that is going to be for the 3rd. There it is. You notice a lot of red here for the U.S. You have average hourly earnings, non-farm employment change, the unemployment rate. You have final services PMI, as well as the ISM services PMI, as well as an FOMC member, but that's going to be presenting after the market close. So all in all, some pretty big announcements happening for the U.S. You'll, of course, have the unemployment rate also for Europe, which is right around 6.5%. So all in all, should be a pretty busy, volatile day tomorrow. Now, for tomorrow's show, I have a whole bunch of questions that have come in, and I wanted to clear some things up because I guess on my show I did the other day, it's a tough one to clarify. I said that the market is not going to go down, and some people took offense to that, like, well, yeah, I can. Let me clarify that tomorrow on tomorrow's show. I'll talk a little about market declines, massive sell-offs and panic moments that can happen in markets. Certainly things can decline very rapidly, and it happens all the time, but an index maybe not so because of the rules that are in place. So we'll bring up that one. I have several other questions that were sent in, so you guys can help me out. If there's something you want me to cover on tomorrow's show, TraderMerlin@gmail.com. You can send in those questions to that, or just put them down below any of the YouTube videos, which is where I got a bunch of the questions for tomorrow's show. But I'm out of time today. Not going to do an hour show. Dave says, any idea when Beck Report is coming back? I know it's tough to get him on. I actually owe him a phone call. I feel really bad. I've been so busy. I haven't even returned one of his phone calls, and he's called me a couple times. But I would gladly have him back on here very soon. He's one of my favorite people. So, Dave, thanks for the reminder. I got to call the guy. So I'll get him on the program. But anyway, that was Bill Addiss. You can find out more information at aftraining.co or go to Trading Academy to find out about his upcoming classes. You got things you want me to cover for tomorrow? Send them in now because I will probably have some time this evening to get them ready for tomorrow's show. Still got a lot of work to do in the studio here this evening, but hopefully I'll get to all those questions. So send them on in. Happy trading, everybody. Hope you enjoyed it today. Thanks for joining us, and I will see you mañana. Take care.